Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors. Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. It's towards the end of June. I want to get into a couple things, and as I often talk about, sort of tailwinds and headwinds in the current environment. And the tailwind to start, of course, is artificial intelligence. So there's just been a ton of optimism really around the economic benefits of AI. And the S&P 500, which again is cap-weighted, includes significant allocations to the big tech-oriented companies, is up well over 15% year-to-date as I record this. And again, many attribute that strong performance to both those individual segment of the company, those companies, so segment of the market, as well as the market overall, to this sort of optimism around artificial intelligence. Now, when things are running a little hot as they are, it's a natural thing for us to be focused on potential or building headwinds. So, for example, we've talked a lot about consumer spending, but another one that we've identified that we've talked about for a while came back into focus recently. The Congressional Budget Office offered up an update to the 2024 budget, which was kind of alarming in a way. And it brings back into focus anyway the idea of a fiscal transition. So I want to take this opportunity in this episode to review the concept of fiscal transition, number one. Number two, get into a few of the details on the CBO report. And then number three, talk about a way forward, like where do we have to go from here? So getting to this concept of fiscal transition, it's interesting because there's a catchphrase we're using a lot and market participants are using a lot called higher for longer. Rates are higher for longer. But honestly, if we go back to after the financial crisis and the Great Recession, basically what really happened was rates were lower for longer. So the Fed cut rates, kept them pretty low. The market followed suit. And for example, the 10-year Treasury yield averaged 2.4% over the decade following the Great Recession and actually fell to average 1.8% for the 3 years from the start of the pandemic. And so these are lower rates for longer. And the natural thing when you have low interest rates, of course, is for participants in the debt markets, if you will, people that want to borrow money, they're going to borrow more money because it costs less, right? So when we look across the economy, the three main segments, consumers, businesses, and our government, basically all three segments, as we've discussed before, have significantly grown debt outstanding. So consumers have borrowed over an additional over $5 trillion. Businesses has added over $8 trillion in debt. And through really what has been constant deficit spending, our government has added, it's almost shocking, an additional $25 trillion in debt. And when rates were low, basically all the buzz was about, it's okay because the cost of debt is lower. And now that sounds good if rates stay low, but obviously what happened is we've had a period of higher inflation and the Fed shifting to a much more restrictive policy. What that's meant then is that the 10-year Treasury yield has jumped up and has been hovering kind of between 4 and 5%. It's right now around 4.3%. But more importantly, in some ways, when you look at the forward rates embedded in the yield curve, this is sort of what the market is signaling. It expects rates to be 10 years from now, 20 years from now. Basically, the view is that the 10-year will remain above 4% for decades to come. And so what that means is the cost of this debt that we're talking about is going up. And that's what's triggering what we think of as a fiscal transition. So what we mean by that is that, hey, across our economy, let's start with consumers. Consumers will be forced to deal with this. So how's that happen? Well, their credit card charges go up, so they may borrow a little bit less there. If they're borrowing money to buy a car, it factors into things. If they have a home and a mortgage, they have to factor in the cost of the higher mortgage payment when they're moving. So number one, we could see a slowdown on that. Number two, we'll see edges where people can't handle it, and we'll see, increased delinquencies and consumers kind of running into trouble. But the market kind of drives a change in behavior. With businesses, it's kind of the same thing, right? So a company will have a bond that it issued a long time ago, and it's got a low interest rate payment. That's great. Then all of a sudden that bond comes due. they have to go back out to the market and reissue the debt at a higher cost. So the company has to deal with that. They have to figure out how to manage that increased cost of debt. And on the margin, it'll probably result in them borrowing less. And they'll have to kind of inject real-time discipline into their practices, or the market will punish them. Their stock could go down. If they get out on the edge, they could go into bankruptcy and kind of cease operations. I mean, there's all kinds of sort of market-driven influences that will cause companies to try to do a good job managing debt, sort of a focus on fiscal discipline. In any event, of course, with $25 trillion more in Treasury related securities, and that's more, right? That means that our government has to do the same thing, and yet we're in an environment where the idea of sort of reducing deficit spending and trying to manage the debt is just not politically palatable in the current environment. And so that's all, okay, it is what it is. But, I mentioned at the beginning, the Congressional Budget Office essentially issued an update to the 2024 budget. And it increased the 2024 budget deficit estimate by 27% to $1.9 trillion. It's $400 billion more than what they thought it was going to be when they did their February estimate. Now, we can point to things like the aid that was passed to go to Ukraine, Israel, and Taiwan. We can look at things like student loan relief, or the FDIC support of failed banks, or increased Medicaid spending. These are all big, chunky expenditures, incremental to this, significant cost. But those and those things I listed are about 80% of this $400 billion increase. And so, the punchline here is that, we're getting to a point where this really is going to start to put strain on the environment when it comes to Treasury debt. As I mentioned, that consumers and businesses will sort of experience more immediate challenges and sometimes pain to get into a better state from a fiscal discipline perspective. But really, as it relates to the government, it's so much more complicated. By the way, another CBO estimate going out 10 years from now is the idea that the cost of our debt 10 years from now is going to balloon to $1.7 trillion a year. That's just the interest payment on the debt. And so those are big numbers, and they really are going to wreak havoc with our budget. What this means is that what needs to come into focus, and we've talked before that this could well be driven by voters and ultimately people running for election, kind of focusing on fiscal discipline and saying, hey, here's how we're going to try to rein things in, basically. But it results in, there's really only two paths to get there. Number one is raising taxes, and number two is cutting spending. And honestly, my guess is we're going to have to do both, but that'll be important for us to monitor when it comes to candidates, platforms, initiatives, et cetera. Well, who's planning to do what? And, what will the process be for voters to kind of have greater focus on fiscal discipline as a means to get where we need to go. And at the end of the day, we've talked briefly before about the idea of leadership. There's leadership in the government, there's leadership in business, and there are people out there that, we all sort of admire. And I think another element of this will be the need for those leaders right across the spectrum to bring this topic into focus and look for ways to be stronger from a fiscal perspective. Anyway, so kind of a heavy topic, but given the CBO report, we just felt really compelled to kind of get it back out on the table. We are, to take it back to where we started, we are in an environment where the market seems pretty optimistic. Markets are going higher, but we should anticipate some volatility based on short-term things like, a slowdown in the consumer here in 2024, but also as well some sort of reality checks as it relates to things like fiscal discipline across the economy, but especially the needs where that's needed when it comes to government spending. So thank you so much for listening to this episode. And I guess we'll catch you next in July. Thanks so much. Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.